Item 8 on the investment committee agenda is the investment policy and management plan, target allocation. This is an information item. Chris?
Hi. When you adopted the 2015 asset allocation targets, fairly large shift, obviously, almost, as we said, over $30 billion to the new asset allocation. Primarily, almost $18 billion of that is RMS, ramping up for the first time, and then the shift within equity from a U.S.-centric equity policy to global equity. I told you at the time we would establish steps as we moved along. Rather than following a time clock, we'll pay attention to the markets and the opportunities. Credit goes to Stephen Carey and the RMS team because they have been able to find managers and fund them up faster than we had originally scheduled. So where we thought we would be at the 9% allocation by June of 2018, we think it's reasonable, depending on where the markets go, but we could get there by February. So we are proposing two small changes. The first is on INV 103. I'll credit the ICER, which is our internal controls and ethics reporting team, with a very close attention to detail of catching the 7% assumed rate goal. But really the main change is on INV 111, which is just adding the effective step of moving RMS to a full 9% weighting based on the start of the year. We won't be there right at January 1, but I think we'll get there pretty quickly, somewhere February, March. And then adjusting the targets then to fixed income. Our next goal, once RMS is up and funded, in June we'll give you an update. We're pretty close to the completion of her shift in global equity. It will be the continued efforts in private equity to ramp up both private equity and inflation sensitive to get them up to their targets. So you've got PCA's recommendation, and it's a first reading, but if it's acceptable to you, if there aren't any questions, you can also make it an action item.
Neil or Stephen, are there any comments?
We think this is more procedural than anything else, so
Thank
we
you.
recommend you move forward with it.
Thank you. Ms. Hendricks?
I'd suggest we go ahead and make an action item and move approval.
Okay, it's been moved by Ms. Hendrick to adopt the policy changes as outlined in item number 8. Is there a second? Second by Ms. Ortega. Any discussion? Seeing none, seeing no objection, that passes. Thank you. Item 9, infrastructure policy revision, first reading, Paul Shantic. Hi, Paul.
Hey, Gary.
Judy Chambers from PCA. Not so familiar face to me, at least.
Hi.
I was just going to introduce
Thank you.
Charles Fitzpatrick, the portfolio manager for the infrastructure portfolio and inflation and other duties in inflation sensitive. So what you have before you is a kind of a modernized version of the infrastructure policy. The idea was to work with percentages in the policy and to, in terms of the overall targets, and also in terms of increasing some of the discretionary limits and some of the manager concentrations, trying to tie them to percentages in terms of growth of the portfolio and or target in terms of the overall portfolio, so that they're clearer, and then changing some of that language in terms of leverage in the policy as well. This is an information item. You can turn around and make it an action item if you so choose. With that, are there any questions? Policies have been reviewed by PCA and internally. It's a 6-month process. It's not quite like giving birth, but it's a long process.
Wow, Paul, I think.
I know, I'm
I
sorry.
think the moms in the room. Would appreciate it that way. I'm not, just saying. Mr. Chair. Moving on.
Okay, I think Ms. Hedrick has a question.
Yeah, I just, Judy, did you have any thoughts or any, I mean, the comments seem pretty straightforward, but do you have any thoughts? I'm fine. Okay. So with that, I would move approval if
Okay.
there are no other concerns or questions.
Thank you. Anyone else with comments or questions on the infrastructure policy revision? Ms. Hendricks moved as an action item. Is there a second for that?
I'll second.
Okay, second by Ms. Yamamoto. Any discussion? No objection? Thank you, that's approved. Thank you.
Okay, thanks, Paul.
Thank you. The next two items are policy revisions from corporate governance, Ms. Sheehan and Ms. Stagny.
So this item, the goal of this item is to establish within our corporate governance policy, the investment management policy in there. Historically, we've been in global equity, going back to when the first governance managers were hired. But with the growth of our portfolio, as well as us now taking over the ESG managers, it was thought we should add the investment portion of the policy to the corporate governance. So this is the first step in that process. Today, what we've done is simply taken the language from the global equity policy and dropped it in our own policy and created at the end, the investment management portion. No change in the language, nothing. At February, we will come back with specific investment policy language around the ESG managers and what we're hoping to accomplish in terms of that strategy, as well as the appropriate benchmarks, which we will bring back then. So this is the first step in that. No new language in here at this point in time, but rather you would see new language in February related to those other two sections. And then anything else between now and then that we may feel is appropriate to add. So like the other, this is a first read. You certainly could take action just to sort of establish that section and then come back and we'd amend then that with the subsequent action in February. So
Pretty straightforward. Just literally moving it from one.
yeah, we're moving it from one to
place.
the other,
Yeah.
and then we'll begin to put together language around the ESG, you know, what our goal is with those managers and that investment strategy, and then the benchmarks.
Yep, it appears that would make things a lot clearer and crisper. So with that, we'd entertain a motion to take that as action at this point, and then in February, the further details would come.
My question,
Sure, yeah, absolutely. Ms. Yamamoto?
So my question, it was confusing to me the way it was presented in the paper documents. So I appreciate the difference of what you're moving a certain section into this section.
Correct.
And then, so when you come back, when we see it again, it'll be in total then?
Yeah.
A brand new document
yeah.
without,
So the reason you had 4 attachments is because you had the global equity policy, and then when we took it out of global equity, so the deletion from global equity, and then you had the corporate governance, and then the red line to show where we took the section into the corporate governance. When we come back in February, you'll see 2 documents, you know, you'll sort of see the red line version with the new language, and then if you accept it, kind of a clean version.
Only corporate governance, we
But
won't have the global.
yeah, global equity will be gone, because we took it out. It'll only have 1 or 2 attachments at that point in time. Yeah, it was a little confusing, but because we were taking it from there, we wanted to make sure you knew where we got the language and then where we moved it.
And before we made any substantive changes to the corporate governance policy, we thought it would just made it cleaner to move the.
Do it in steps. Because it would have, if you thought it was confusing, it would have been really confusing if we had done it all in one sweep.
remember, I'm new to this
Yeah.
thing too, so, it was really confusing. Thank you, though.
Ms. Hedrick?
I would move approval. So we'd be approving this version today.
Yeah.
And then knowing that we're gonna see it coming back with
Yeah,
the.
you'll see it then with
revisions.
additional language.
Okay.
And it'll be a first read of a cleaner version. That's why we
Got it.
thought maybe it's helpful to approve it today, so it'll be a little cleaner.
Nothing substantive changing in what you're
Nothing.
doing.
We literally lifted
Yeah,
language.
very good. Can we get a second on that, to take it as action? Okay, moved by Ms. Hendrick, seconded by Ms. Yamamoto. Seeing no discussion or objection, that is approved. So item 11 is also for you,
Yeah.
Ms. Sheehan, proxy
And this
principles?
is, as we do historically, after every proxy season, we sort of look through our proxy voting guidelines and see, okay, do we need to tweak things, edit things, update things a little bit? So this is some minor edits, updates to our proxy voting guidelines. Again, it's a first read, but if you could take action, that would be great, because we'll start voting. Not before February, but it'll be helpful, so either now or in February. So the couple of, we can just highlight, the board independence, historically, on our proxy voting, we have used kind of one universal standard for board independence, 2/3, which is great in the United States, but in some markets where they're slowly moving to board independence, we end up voting, and you'll see it in the proxy voting report, we vote against a lot of directors in non-US markets because they don't meet the US standard for independence on boards. And so what the staff thought this year is if we could have a little flexibility in the proxy voting in non-US markets where we could give credit to those countries and companies that are moving towards independence. They're not at the 2/3, but they are moving to put more independent directors on boards. So that's the board independence language. The director tenure, you know,
And can you just reference the page? Thanks.
Sure. I want to find, here, let me go on. Okay. So 276 is the board independence. So as you can see.
1B.
Yeah. And it's the blue lined. But it makes it sure that in some countries, independent boards are not, so we'd like to at least be supportive of some of these, and so it'll be a case by case, but we would like to at least send the signal that we applaud their move towards independence.
Got it. So the language there allows you to do that? I'm just
Yes.
trying to, so it's not a number or a percentage?
Correct.
It's just
Because
kind
different
of
countries
general latitude.
are making progress differently.
Got it.
So Japan's a good example of that, where we vote against almost the whole board if they don't meet our 2/3 independence standard. But because they've instituted corporate governance codes and they're trying over time to increase the independence there, we want to be able to support those directors that are independent.
So we would support the ones that are, we may vote against some of the inside ones still, but we'd support the ones that are independent.
Yeah, we don't want to be perceived as the big hand of
Yes.
America
Right.
telling the
Yeah.
rest of the world how to, function in all aspects of their lives, and to acknowledge movement where we've seen it, essentially, right? It's
We
cultural,
don't have
they're
America
cultural.
first.
It's a cultural issue.
Yeah. Ms. Dillon?
So picking up with that theme, and this is some of the stuff that I wanted to talk to you about that we forgot to talk about, so.
I got your email, though. Finally.
Yeah, I don't like not having connectivity in here. Going along with that board independence, we're actually changing the are not to may not be with the threshold of 20%. So we're making it more permissive. Is that to give us also some leeway in some of those areas that they're making progress or?
So this issue is actually related more to, there are some directors, if they sit on the board and they own a significant portion of the stock, what happens is sometimes we inadvertently end up voting against directors that are actually very aligned with the performance of the company, and so we want to have some flexibility, yep.
So that's for all directors, not just non-US?
Correct. Because controlling shareholders or a large shareholder isn't always bad. Sometimes it can be an outside person that's very helpful. And so having a little bit of flexibility in that regard is helpful. Okay, and then the next change is the director tenure. And we want to make sure as boards talk about refreshment that they look at the average tenure. That some have retirement age, some have term limits, but we want to make sure that they are constantly reviewing the tenure of their board and sort of how the whole board looks at that. So that really is sort of more encouraging boards as we meet with them to talk about average tenure. Diversity, I think this is the one I mentioned before about just giving us, strengthening that section on voting against if they are not if they have not taken action. The auditor rotation tenure, we needed to change our voting guidelines on this because of the decision the board has made on the auditor tenure. And so we just put in language about encouraging boards to review the tenure of their auditor and whether it's impacting the independence, and if so, you know, maybe go out and re-tender for that auditor on occasion. Proxy access, we want to make sure when we support proxy access, and that we can make sure it's 25% or 2 directors. Sometimes the way companies write these things, you get like 1.8 director, and it's a little hard to vote on those things. So we want to make sure it's clear that it's a whole number of directors or 25% of the board. And then strengthening the section on, it's very important for us, as I talked about, shareholders' ability to amend the bylaws in extreme situations. It doesn't happen a lot, but we want to make sure that we have the ability to do that and that our language reflects that we don't want companies to do anything that limits our ability in those extraordinary situations. It doesn't happen a lot where shareholders have to go in and file a proposal to amend a bylaw. It has happened. We did it at Freeport-McMoRan a couple of years ago, and it passed overwhelmingly. But it's an important shareholder right, and we have seen a trend of some companies beginning to take steps to limit shareholders' ability to do this.
And in some states, so Delaware allows for companies, shareholders to amend the bylaws. There are companies that are incorporated in other states where they do not have this ability, and it's gotten increased focus. And so we just wanted to make sure our principals were clear on that point.
And that is it.
Ms. Dillon?
So going back to proxy access, the new language reads current company's proxy statement. Don't you mean company's current proxy statement? I mean, the company,
Yeah. Yeah, we can change that.
okay. Thank you. And I think I only have one more thing to talk to you about later.
Perfect.
Director of Editing
I know.
and
She's good.
Paper Preparations.
She's good, yeah.
She sure is.
We should have her read
Well, I
it
was like-
before, Chris, we should have sent it to her before we
Well, my
There
next
you go.
question was gonna be, how many times have they tried to pass off the old company's bylaws on you?
Anything else, Dana?
No.
Okay, Ms. Hendrick.
I know, I feel like I'm channeling you, Dana, right now with my question, which is back to the auditor tenure rotation. Because I don't usually do this, but Dana's, you've rubbed off on me, I think. I was just, and maybe it's because I'm in contract negotiations with my district right now on our next contract. But the language that you use in the blue, I just noticed a lot of the language that you're using throughout says things like supports, I'm trying to think of other examples of where I see it. I lost it. But to me, the language there, I was struck by, when you say encourage boards to periodically review, is there a reason why we don't have language that says things like, you know, they should?
We did.
Okay.
We actually wanted them to rotate their auditor every so many years, but we felt it was difficult since you changed your audit rotation policy for us to tell boards to do something we ourselves are not
So we changed
doing.
our policy to a encourage language instead of a should language?
No, you actually, because we wanted them to do audit rotation every 7 years.
Okay.
And then every 10 years. And because of the change in your selection of your auditor, we wanted to make sure our policy sort of just strongly encourage rotation. So that's why we tried to come up with language about encouraging without mandating rotation.
Okay. I'm just always thoughtful about, because it just, sometimes when you say things like that, it sort of sounds like I encourage you to charge less for this, or,
Well,
which
we talk to
doesn't have
them,
the same weight.
especially companies with long tenured auditors. This is something we talk about because we do think if it is too long-term, it can sacrifice their independence because some of these can be quite lucrative contracts with these companies. Last year, we sent letters to companies that had the same auditor for over 100 years and said, somewhere between 10 and 100, maybe you could rotate your auditor and get a fresh perspective.
Because the second sentence is more emphatic, which is like, they should have a policy. So we're saying companies should have a policy that says, this is how we're going to rotate our auditor. But that first sentence just strikes me as,
I think we're trying not to be too
I
prescriptive,
got
but at
it,
least.
yeah, got it, all right.
Aspirational is.
Aspirational, yes, we'll go with that. And maybe we'll revise this policy in a few years and it'll say
Back to
should.
Saturday Night Live.
All right, thanks.
So this is an information item.
But you can,
We could take action on
We
it.
shall.
That's why I decided to
So-
pursue.
if you'd like to.
I'd move approval.
Okay, so it's been moved by Ms. Hedrick,
Second.
seconded by Ms. Dillon. Any further discussion? No objection. Before, motion, that passes in action. But before you leave, a more general question, just in terms of your engagement, with the changes in these policies, the language that we're changing, historically, as we've looked to partners with other institutional investors, do you sometimes find yourselves unable to engage at the level we want to because our policies are not necessarily as aligned with maybe some of the folks we traditionally would want to partner with, or that's not necessarily, that hasn't happened? You don't see
No,
that?
on some of the broader issues of the collaborations,
It's-
usually, the reason we come together is because we're all in alignment.
Good.
There are a few issues where some investors have different chair CEO is a very common one, where some of us have different views. But the lion's share of our engagements and discussions with other shareholders.
Yeah, I was just
We're in alignment.
That's what I was hoping to hear, that there's not something inside of a policy that prevents you from partnering with
No.
folks that we would want to partner with.
No,
Okay,
nothing.
great, good, thank you. Okay, this brings us to the semi-annual reports, which are items 12 through 14. Item 12 is the general consultant semi-annual report. Neil Rue.
How much time would you like to spend on this, Mr. Chair?
Well, it's a semi-annual. You have 20 minutes. I think it
I
would
don't
be
need to
important
spend
that,
10 I don't need to spend that much time, but,
yeah, well, use your best professional
Okay.
judgment.
Great.
Give us a good overview.
okay.
On the day of the last game of the World
So you
Series.
have it boiled down to, you have it boiled down to a one pager if you look
We're
at.
also meeting in closed, so, yeah.
Yes,
yeah.
right. So I'll try to be somewhere between 0 and 20 minutes.
10 and 100 years.
That would be prudent.
Yeah.
Just start.
So you got INV page 305. Just a couple of comments on this page, and I'll hopefully be able to wrap it up. Over the last fiscal year, it's been pretty amazing. Your portfolio's added, as it says here, through the fiscal year, it added 18 billion. That's after money went out the door to pay benefits. As Chris highlighted in other areas of the report, it just has kept on continuing. So through the third quarter, you added another 8 billion. And October, which is supposed to be a lousy month, actually turned out to be a pretty good one. So you probably added another couple billion on top of that. So it's just an amazing amount of capital that investment results have produced for your portfolio. You can see down on the lower right-hand side, your staff has been fairly diligent in terms of maintaining the allocations relatively tight to the prescribed policy targets, really not out of alignment. You see a little bit of an overweighting in public equity, but that's just because private equity is a little bit challenging to implement. So there's a little bit of misalignment there, nothing to worry about. In fact, as Chris highlighted and you approved new targets. Once those targets get put into place in the beginning of the year, you will be even tighter aligned than you are now. Just looking at the results, your portfolio is up. I'll just focus on the 1 year, the fiscal year column. Your portfolio is up 13.4 relative to a benchmark of 12.6. That's an 80 basis point net of fee excess performance for the year. That excess performance is the best result since 2011. So that's pretty solid results historically. It's not shown here, but relative to your peers, it's pretty amazing. No matter what peer universe you look at, you're a top quartile fund pretty much since the global financial crisis. So that's just a phenomenal result. And then you have, as you well know, there's a couple of revisions going on in the portfolio. I mean, the global equity rebalancing, from the U.S. emphasis to the global, putting more money to work in non-U.S. for the sake of a better term, could not have been it's almost right on top of when international started outperforming the U.S. And over the last year, non-U.S. markets, as you know, have outperformed by about 200 basis points. So to get that rebalancing put in place, you've been able to take advantage of that outperformance. The timing's pretty nice. And then the fact that you're a top quartile fund and you've had this great absolute performance, great relative performance relative to your benchmark, and at the same time, you're shifting money into the RMS, that seems to be a very astute timing as well. We could talk about that a little bit more detail during closed session if you'd like. But just those types of trades and be able to maintain the level of performance is just the evidence of a very well-run fund through the last several years. So those were my comments, and I'll stop there.
Thank you. Thanks. Stephen, Court from Nikita.
One further comment, perhaps to make Chris and his team blush a bit more. Sometimes in the investment world, inaction is harder than action.
Right.
And I think Chris and his team have done a great job of keeping invested in a market where there's been many reasons to de-risk over the last many years. And I think that's also contributed to the strong performance of the plan.
Thank you both very much, and thank you to the staff for your work since the great financial crisis. I think Mr. Rue expressed it quite well and spot on as to what the performance has been. Stephen McCourt just spoke about the risk of inaction versus action and some decisions that have been made along the road the last couple of years. Now the challenge is to continue that forward. So thank you for a good job well done. Let's keep it up.
Yeah.
Okay, thank you. Semi-annual performance report, Michael and McGee from the Townsend Group. Welcome, Michael.
Good afternoon. I'm going to actually continue with the same basic theme, and I have, there's slides, thank you. You changed your pointer.
We did change it.
I'm just going to focus on one slide and give you an overall view of the real estate. 12.2% real estate funding. You are within your range. We continue to be at the low end of that target, and that's consistent with the comments that were made by your general consultant. Your staff's been cautious. We do think that we're at the very long end of, some of you were here before, of a great party, but it will come to an end at some point. And your staff has de-risked your portfolio and made you more conservative within the structure of what they do on a going forward basis. And I'll reference back to that a little bit in just a moment. You do have capital available for investment, also a great concept in a market where we expect some kind of a correction. It's not going to be the great financial crisis, I certainly hope not, but you will have some level of market dislocation, thank you. And what you want is to have capital available to invest when others are too afraid to move. And that will be a significant advantage to you this time around that really didn't exist last time because your allocation went down or up above its target. Focusing in column number 1 where we talk about composition, I've focused this analysis on the excluding legacy. If you looked at that column with the legacy assets in it, you would be 58% core, 16% value, and 27% high return. So this really reflects the shift in the risk profile of your portfolio. It also shows you that on a going forward basis, since about 10,000 basis points of that high return has already been written down and suffered greatly from the financial crisis, that you have a good solid 17% of your high return, of your total portfolio in this market cycle's upward movement. So you've got good returns, as you'll see over to the right. Within the leverage, you're significantly down from historical levels, conservatively leveraged. We would suggest that this would definitely bode well in a market correction. Leverage works great. It is a double-edged sword. It cuts on both directions of the market. In a decline, you will be less levered than you were last time, for sure. And that impact makes that more de minimis impact in the negative direction when a market correction does occur. The returns, we've been asked to focus on the longer term, and your 10-year net returns look really bad. If you just look at those red squares with all of the existing non-core investments that were done prior to the financial crisis, if you take those investments out, exclude the legacy, you can see what your go-forward portfolio is achieving for your program. I would also note for you that the newer investments, not only are they doing better, but they are also in much more controlled positions, meaning you've done co-investments, separate accounts, joint venture vehicles, and vehicles where if the market moves, you have control over that liquidity, whereas the historical investments, as you've seen, were 8 years out or 10 years out from a market correction, and we still have a lot of that high return money placed in the market because you can't control it or get out of that. It's at the discretion of the managers. So this time around, you'll have a greater position of control. We also, I had mentioned the position of your going forward. You won't escape the market. You will experience the same correction as anybody else. You will be more conservatively. You'll have that capital available for investment. And although not part of my performance report, but I do want to say that it was an interesting time to join the CalSTRS team in 2008. It was difficult, if you'll remember. We spent 2 years just trying to figure out how we wanted the portfolio to go forward, what risks you were comfortable with, how much control you wanted to have. I would suggest to you that you are right where you wanted to be. It didn't take us all 10 years to get here, but we certainly are where we thought that the portfolio should be, and again, well-positioned to go through the next market cycle. It's been a privilege to work with you, and I know that many of you know that I am married to a teacher, so I will still continue to watch you, and so I encourage you to behave. And I'll take any questions you have. It's been a privilege.
Okay, thank you, Michael, and we'll see you in closed session. Next is the semi-annual report, private equity, John Haggerty from KETA. John, come on up.
How do we move this? Thank you. So we'll begin with a review of the 6-month period ended March 31 of this year. And as you might expect, very little changes with respect to the structure of the portfolio. Some of the remarks that we'll have are to the nature of things being unchanged relative to the last report. That's also the case with respect to the performance, which Steve will touch on a little bit later. The portfolio remains very prudently diversified by manager and by strategy. Buyouts continue to dominate at slightly less than 2/3 of the portfolio. The portfolio is dominated as well by U.S. investments, which are slightly over 2/3 of the portfolio. The concentration in the 4 vintage years of 2005 to 2008 will remain. And the good thing is that those vintage years are largely called, so the exposure is what it is at this point in time. The next slide speaks to what happened specifically over this period in terms of valuation change. It was positive. Total value increased by $1 billion from October 1 through March 31 of 2017. And since inception, and for shorter periods, the relative performance story is pretty much the same, ahead of the benchmark since inception and slightly below the benchmark for periods less than 10 years. And as was referenced earlier in this meeting, the question of whether you've done better or worse by investing in stocks or in the private market portfolio is clearly answered by the PME analysis that we've presented at prior meetings, where there's a substantial amount of value that's been created by the private markets program, and that remains. In terms of specific activity during the quarter, all told, the netting of inflows and outflows showed a positive, meaning an outflow to the retirement program of roughly 0.6 billion over that period of time. And during the first half of the year, we'll talk a little bit more later about pacing. The staff made 3.5 billion in commitments, and roughly 2.5 billion of which were made during the second quarter. So there's been quite a bit of activity to move the program towards its long-term target of 13%. This shows you the dollar figures. The value of the program at the end of March for the snapshot was 17.3 billion. If you add to that the unfunded commitments for each of the funds to which you're committed, that totals 29.4. The exposure that you had, or the NAV, was slightly down from the prior snapshot 6 months earlier. It was roughly 8.6, and it's down to 8.3, and that has to do with the very strong stock market performance that was just outlined in the previous presentation. The short-term target is 9%, so we're quite close to that. The longer-term target of 13% is something we'll talk about a bit later with respect to pacing plans and some initiatives to deploy capital in different ways.
So John largely covered this, these points about the allocation decline 8.3% and the in dollars is the main exposure in U.S. companies. So I want to take a moment and talk about this slide here. You've seen it before, essentially showing the cash flow activity in the private equity portfolio has been strongly inflowed towards the plan, and while that's good, it just makes it more of a challenge to actually deploy capital out and help grow the program. So it's nice we're getting results back, but in order to achieve the interim and the longer term goals, it's just a bit of swimming upstream on that. That being said, it seems like this phenomenon is starting to wane to some extent. There was a large number of funds that were raised in the 2006, 2007, 2008 time period. And as those investments have been maturing, those GPs are selling them off, and that cash flow is coming back. And so the more recent vintages are starting to take over. So we should see that the balance between the cash inflows and outflows start to be more in balance, and we're seeing that in the first quarter. In terms of the performance here, there's not a tremendous amount of change, particularly from the last report we did, particularly for the longer time periods. As we mentioned, the since inception return went from 12.9 to 13%. I would note that the uptick in the public markets has improved the performance on the short-term period. So the last time we reported, the one-year performance was 8.4%, and we're seeing here now at 14.9. That being said, there's really not a lot of value to be ascertained from just one-year returns in the private markets. It's the longer-term time periods. Those are still slightly below benchmarks in the custom benchmark. That's essentially all that we have in terms of our prepared remarks. Happy to answer any questions.
Mr. Rosensteel. Paul.
Thanks. So I actually want to ask some questions about this in the context of the email that was sent by the private equity staff to the board about the 10-year rolling averages. Because we've had these conversations at previous meetings about what's the best way to measure private equity performance and over time and looking at trends. And you know, we spend a lot of time talking about results from inception, the public market equivalent measure, which I'm very glad we did. I was the one who asked for it, and it has told us wonderful things about the benefits of our plan. But it's a we're always referring to it over the life of the program. So I think we got from both PCA and Makita the idea that looking at something like a 10-year rolling average, and I know Steve McCourt had mentioned this, was an interesting way to kind of see, because we know that private equity goes through cycles, and we know that where we are in the J curve and whether we're having lots of money coming in or money going out makes one-year measurements not very accurate, but that some kind of a 10-year rolling average should even those things out. And so we were given a few days ago this chart and this email, and my question really have a lot to do with that, because I'm still trying to, in the context of the fees we pay, of the returns we get, of the risk we take, and of what seem to be, challenges to putting the money to work, and we revised the targets and have over the last few years. If you look at the rolling averages, and we've got 11 years of rolling 10-year averages, and if you look at that 11 years, and you look at the first half of that period of time, the returns relative to the public benchmarks are remarkably good. Depending on which public benchmark you look at, it's 8, 9, 10% benefit. But if you look at the last 5 years, it's more like half that. And if you look at the trend over those 11 years, although it's not consistent, it's generally a declining benefit. And then if you look at the cost report we've gotten, and I know our issue is net returns, but basically, looking at the last couple of years based on the cost report we heard earlier and the material in this email, about for every percentage point that private equity is earning in over the public benchmark, which would cost us nothing or virtually nothing in terms of fees, we're paying about the same amount in fees. So we're paying about 400 basis points in fees. We're getting about 400 basis points of benefit over the index. And we're taking a lot more risk for that, presumably, right? I mean, we're taking risk in terms of we measure the volatility of our private equity and portfolio at 25%, and our public equity portfolio at 19.1%. So we're taking on a lot more risk, and the trend seems to be going in kind of the wrong direction. And I know that the email tried to say, well, here are lots of reasons that we should qualify this, where we are in the J curve, and all of that kind of stuff. But I thought the whole idea of a 10-year rolling average was to eliminate that impact, that a 10-year period of time is longer than the average holding period for any one of our investments in private equity. So, and I know that we keep hearing that the private equity market is going to get better, but on the other hand, it seems to me that everything I hear is that more and more and more people are trying to put their money to work in private equity because they're trying to get a better return. And so why should we expect that private equity is going to get better as an asset class? It seems to me that it's going to be driven more down towards where public equity is. So I just, I'm trying to figure out how we can have a way to think about whether we're really, getting benefit from private equity given the risk we're taking. Our fiduciary council has told us to worry about risk. If we were at 8% of our portfolio, to eliminate private equity entirely and move all of that to index public equity, our expected return, based on the recent experience, would be about that the portfolio would go down by about 25 basis points in yield. Now, that's a lot. That's a tremendous amount. On the other hand, it's also a reduction of risk, and how much risk is it reducing? So I'm just trying to get a sense, because I think we just keep hearing that there's a promise to private equity, but that promise seems to me, looking at the numbers, every year to get less and less compelling. And so I don't think it's good enough to just say, well, the public market equivalent showed that we made a lot of money. We did, and that's great, and that's in the past, and that's fantastic. But there's new information and there's new trends, and I would just like to hear from our consultants. You're our advisors. Am I off base, or how do we look at?
If I can interject for a second, Paul, I don't disagree with the direction of your question, nor do I think we shouldn't hear from the consultants, because within your comments and your question, I think is a broader issue for the investment committee to work with our consultants and staff on. One is the amount of capital in the globe, around the globe, chasing fewer and fewer deals, the aging of some of the most mature private equity firms that we've had great relationships with over time, the changes in globalization, et cetera. And I think our advisors and consultants have said we're going to expect less from private equity going forward than we have in the past. But I think your larger question is one that probably needs to be agendized as a more comprehensive look. I certainly want to hear from them today, but I think what you're getting at is a much larger, deserving of more time, more research, and greater exchange. Because that's what I'm reading and picking up on as well. There's a lot of capital around the globe, sovereign wealth funds, we've heard from Chris, chasing fewer and fewer deals. The big managers that we've had great relationships with over time, a lot of those founders are getting older. What are their succession plans looking like? I'm not the expert, but I do think it would be a good discussion for us to have. So we can talk about how to agendize that for a future meeting. I think at this point, it's a semi-annual report. If they could somehow capture some of your answer to some level, your question.
That's fine.
But I think a larger conversation. I'd be open to how to
I'd love to have
agendize
a
it.
longer conversation agendized about that.
We
So that would be
can
great.
talk
Thank you.
offline and figure out how to do that appropriately.
Thanks. It's a fantastic topic to have a longer discussion on. Just, I wanted to address the questions first from an asset allocation standpoint, because I think there's two levels of the question. The first is very broad. Is the asset class a productive asset class for you and for every other investor on the planet? Second level of the question is, for a variety of reasons, mostly having to do with the size of CalSTRS, can CalSTRS deploy capital in an effective way within the asset class? So there's a question of whether it's effective for you, even though it's effective for other investors. At this stage, I think our answer is yes on both. It's productive. In the last asset allocation study that CalSTRS conducted, roughly, going off memory here, the return premium to private equity modeled in was about 2%, low nines versus low sevens for the global equity markets. That's probably lower than what you modeled in 10 years ago and 15 years ago, and I think that speaks to Mr. Rosensteel's comments that the private equity marketplace is getting more competitive, as all marketplaces are. And I think it's important every time you do a cycle of asset allocation review and look at the forward-looking return analysis, you review private equity within that context. And I'll let John and Steve add anything more specific on the implementation side.
Yeah, so I think that, as Steve was saying, there's the strategic aspect and there's tactical aspects as well, right? And I think that what we can talk further about is the ways that staff is, and we're working with staff on how they go about deploying capital there in ways to try to have the best chance possible to have good rates of return. And that's looking at building the portfolio in terms of the funds and how they allocate that, how many managers they have and how diversified and the different strategies and sectors they're in, as well as approaching things on a cost perspective, doing more co-investments and doing secondary investments where they can, and separate accounts where they can help reduce down the fees. So these are some of the tactics they're going about to try to bring about a better net spread and approaching, both aspects of it, both building the portfolio as well as on the cost side. So we can talk more fully about it, and we have some further comments we can talk about in closed session about some of those tactics that we can start addressing.
That's spot on, Steve, because I was going to mention that there's probably some insights that the staff and advisors can give us as to how you're thinking about these and would be appropriate for closed session going forward. So, John, did you want to add anything else to the comments?
I'll leave it at those comments for now.
Great. Any other questions or comments from
Can I
colleagues?
just clarify one thing?
Sure, go right ahead, Paul.
Yeah, thank you. And I appreciate that. And obviously, what we want to do is figure out how we can do a better job. But I guess what I'm still looking for is some guidance, and again, we don't have to do it now, but some guidance on how we should understand the data we're seeing. Because I sort of have this feeling that we look at this data, especially this material that we got in the email, which was kind of a suggestion about the way to take a look at long-term return trends from our consultants. And yet I don't hear any conclusions drawn about that. And it's sort of like, well, all we care about is what we're putting into our investment policy going forward in terms of expectations. And I know that they're in part driven by what the past has been, but I'm still trying to understand what conclusions we draw from the experience we've seen in the past. And I'd like some better guidance on that when we have a longer conversation. Thank you.
Thanks for that, Paul, and thank you for the semi-annual report. Look forward to some more of the details in closed session. It'll be helpful. Thank you. Brings us to the next item on our agenda. The work plan project, co-investments and direct investment opportunities. This is supposed to be really just high level and get us all on the same, using the same vocabulary. So different staff coming up and speaking to us about what we're currently doing in this space. Paul Shantic, Margot Worth, and Mike DeRay. And Mike, I think everyone saw the videos that you sent out. They were helpful. I think we'll work with the chair of the board and the staff to figure out how we may be able to expand upon those, making sure we're working with the legal team and whomever else needs to be involved. But I think it has the ability to be quite helpful and informative for the committee on some of these topics that we don't have to take up board time, but clearly there's issues around confidentiality we want to make sure we have, and security purposes and legal, so all of that. But it was, I think everyone saw the video.
Okay.
And
So, well,
I'll turn it over to you guys.
That's very helpful, so I'll just make some big picture comments on it. And obviously, I'm up here with Margot and Paul, right? They introduced themselves earlier. The big picture is, excuse me, cough drop. The big picture is that we're looking at ways to do more direct investing throughout the whole portfolio. This particular item is focused on the private assets because there was a lot of work done on the public assets almost nearly a decade ago. So it's going to be a 3 or 4 part presentation. This one was really to educate the board on the various ways that we can do direct investing and the various structures that we have. And I'm going to kind of push through what was in the video and kind of go to some concluding slides. But what we hope to, and to parrot some of the things you said with respect to the slides, they are available on the internet for the public to see. So some of the optional structures that we talked about that would go into building a portfolio, they can be funds, which was the basic structure that you have in all the private asset classes. And we can also do various levels of co-investment, custom accounts, and company investments. What this means is that's consistent throughout the portfolios. We'll have higher discretion that will go to staff, generally lower fees and lower net fees. But there will be more cost at the staff level, the legal level, that will go directly to the fund. In addition to that, there will be more liquidity in the portfolio because we'll have control. That's really one of the key things that we all value a lot, is the control of the portfolio, the control of major decisions. So it doesn't really matter by asset class or by strategy. That's what you're going to find. One of the other things we found is that direct relationships are easier to put together the lower the risk. The higher the risk, the harder it is to have a direct relationship and going and disintermediating the system. And that kind of makes sense if you think about it, because using real estate as an example, in a core portfolio, there's not a lot of differentiation in the pricing of core assets. Whereas if you take the extreme of maybe saving something complicated like distressed debt, you really need some very focused talents and skills from general partners to do that. And it would take time for a staff to get up to speed and create all the relationships and have the capital to compete in that situation.
Mike, before you leave that, I just want to jump in because there's, I think, some language misnomers. We hear people make the comment all the time about the Canadian model. And if you can go back one page, there is no one Canadian model. It's a governance structure that's different, but it's actually not even up there as an option. So we're not jumping to that. And the thing I want to draw out for the board is there's a whole range of different business models between where we are and where they are. And it encompasses these types of different investment activity. So we're not jumping to that conclusion. It's not a black or white issue. We're actually looking at these variety of different business models and different ways to invest that are within our governance structure. And then the goal here is to study it. We talked about it in July of what we do now, and we're going to integrate that. Here's what the options are. We'll come back in February with a panel of people who have done this at other places and what their experience has been. And then hopefully shoot for May, where we'll come to you and say, you know, based on this, here's the things we think are reasonable. Here's what might have to change. Here's what we'd have to do differently. And that way you can then plan out in 2018 what it is you want to study. But I just really want to emphasize, don't jump in your mind to what we are to what a Canadian fund is. We're looking at all the things in between those as options and different structures of ways of doing business.
And they'll vary by opportunity and by asset class. So I can talk about kind of next steps of what we're going to do. We've already started a process of interviewing a number of the sovereigns and the pension plans that have different models of what they work with. The three of us, along with Geraldine, went up to Toronto for a few days and interviewed the top 3 Canadian funds that have the Canadian model, if you will. So we talked to each of their asset class managers and understood what they're doing. We'll continue those conversations. I think June and David went up to Toronto and met with them on the public side as well a week or 2 ago. We'll have conversations with British Columbia. We're going to have conversations with our brethren, U.S. pension funds that have interesting ways that they're trying to go direct. Margot, maybe you can say what the thing you went to last week.
Yeah, I was at a industry roundtable with probably 30 of the larger investors, more forward-looking investors in the world, a lot of Canadians, a lot of sovereign wealth plans, and a group that has very much moved toward the direct model over the last 5 to 10 years plus. And a couple U.S. state plans, state pension plans.
So that will be continuing. We'll also start to engage our consultants across asset classes to get their views of what's happening, what other clients have done, and we'll learn from that. And in total, as Chris has already mentioned, we're going to come back to you in February with a more robust opportunity set that's available, and also some guest speakers that can address some of the, hopefully some people that have brought their organization through it, and some people can talk about the opportunity set going forward. And with that, we'll kind of open it up to the board for questions. We can talk about the portfolio if you have specific questions of what we've done in each asset class right now, and or a change of direction of what you'd like to do between now and February.
Thanks. Ms. Hendricks.
I'm really excited about this, this study that we're embarking on, because Chris's comments are stuff that I've been thinking about a lot, because I've been hearing about the Canadian model since I've been on this board. And when you talk to Canadians, they have a lot of pride about that, which I respect, but it's challenging at times to feel like we have different governance issues and challenges. And so I like the idea. I feel like in the 5 years I've been on the board, I see the ways that we try and glean best practices from all of our colleagues around the globe, and then figure out for CalSTRS, for us, for our members, what are the best ways that we can kind of think about some of these ways of doing it. So I'd love to have like a CalSTRS model is sort of my hope at the end of next year, because to me, it's, you know, we've got to do what's best for us, but I like the idea of learning from our colleagues around. But I really like this idea of you can't just sort of transfer one model to who we are. I like the idea of studying and hanging out with the smartest people around the world, and trustees and managers and staff, and then figuring out what works for us. So I'm very excited about creating the CalSTRS model next year. So thanks for the hard work.
Ms. Paquin?
Thank you, Mr. Chair. We appreciate the work on this as well, too. And just, I was curious, I thought I read in the report that CalSTRS currently has a small number of company investment positions in operating companies. And I was curious to find out a little bit more about the governance structure of, we have a seat on the board, or if there's any issues of alignment that have arisen from ESG positions.
Sure. The company ownership positions we have are all located within the real estate portfolio, and they came to us in kind of strange ways. They were an opportunity in some cases that were thrown in with the portfolio of assets. I can think of one where the only company we own a majority share of is called Elcor, and we bought that at the same time we bought from the Lehman estate. Excuse me. At the time, they were liquidating the entire Lehman estate. So we bought $800 million of assets in this company for $20 million. So what we've done in the case of governance in a situation like that, since we don't have a deep background, is we hired a third party that actually has private equity experience to do oversight of the company. In the other cases we have, where we have a minority share of the company, we have hired third parties to assist us in the governance of the organization. And we recently had an IF do some detailed work on what is the proper way to do governance on a going forward basis. And that, we can make that kind of information available to the board if you'd like. It's not a deep amount of investments, by the way. The total portfolio of the company ownership we have, the real estate portfolio is roughly $26 billion. The total of these 5 companies' value, I believe, is less than $300 million.
Thank you, I appreciate that. And I appreciate having a little bit more information if we're going to be studying some of these different operating models about what you found out so far from the small stakes that you have in these operating companies for governments.
We'll do that.
Thanks.
Mr. Rosensteel?
Thank you. Yeah, I'm so happy we're doing this, and it was a great way to kick it off with the new video star Mike DeRay.
YouTube videos.
Yeah.
Camera has 10 pounds.
One of the things that hasn't been mentioned, though, is the Argo investment, the Argo structure we have, and Paul, maybe you can talk a little bit about where that fits in, because that seems to me on the infrastructure side to be a different model and more of a direct model that has been promising.
Yeah, it moves in that direction. It's not the direct model, but it goes back to the issues of control in that, in the Argo model, both of the investors involved, or all the investors involved, involved have to agree to go forward. The manager goes out and finds, brings it in and says, is this something you're interested in? And we go through valuations, we go through the diligence side by side. So it's different. It's a lot of work. It's very intensive work on time pressured and deadlines. We have, on a co-investment, it's kind of the same thing. You may have a week or 2 weeks to come to a decision. Granted, you have a manager helping you out, but you have to come to those decisions as well. It involves a lot of cross-communication with all the partners. And I think the biggest thing that we've learned from it, as fascinating it is and as interesting it is the time commitment and the expertise that you need on staff that you develop, hopefully over time, to do some of these more direct type things. It's not the direct model, but to take more control over the investments.
So is that model going to be part of what we're going to be considering in this study?
Yeah, it would be, yeah, it would, go ahead.
So that would be part of the custom accounts. So custom accounts can range from, we might call that a club deal, where it's two partners working together, maybe two or three partners working together and having discretion amongst the partners. Or you can do it where you're only one partner, or you can have a joint venture. And that's why we're trying to work this out and trying to have these big picture of how we're laying out the differences. But in each asset class, there's different nomenclature, but essentially it's a custom account where CalSTRS or various other large investors use their size and their ability to make quick decisions in order to create a relationship with a major partner and have deal flow come directly to them.
Any other questions or comments? Mr. Elman.
When you think about the three asset classes sitting in front of you, Margot and her team are really using that first box of funds and that second box of co-investments. Paul and his team are using funds. They have the right ability to do co-investments. We don't have much right now, but also up to custom accounts. And then Mike in the middle is actually using all four. So that's part of the point, is we're using them in different ways. They don't always work in every single asset class. Big custom accounts or owning the general partner in private equity isn't necessarily the best thing in the world. And we got to look at whether that really works in private equity or not. One of our partners in Paul's portfolio, IFM, is actually owned by a bunch of Australian pension plans. So maybe that model actually works in infrastructure. We're finding it works in real estate. So that's part of the thing, is I think we want to send the message that we're looking at all of these. They even have shades of, as you're describing within the custom account, shades of color within that particular box that we're describing it. But one of the hard things, we wanted to give you a common language so that Paul doesn't call it one thing and Margot another and Mike another. We're going to try and stick to this lingo and then try and tell you where the investments fit, what's efficient, what's inefficient. But I think that what I would draw your attention to, Mike did in the presentation on the videos, is those little words at the bottom. Is that basically as you move across the scale, you move to things where you have more discretion, more involvement in the investment decision process, and generally lower fee structures. Not to say the fees are low. They're far from low. They're still expensive, but generally lower. So you're moving to more, as Mike said, more control, more discretion, and a better business model, hopefully, over time. So that's why we're going to look at all this stuff. There's no question, even within the famous Canadians, the volume of their portfolio is still done in funds and co-investments. They're the best of them probably have half of their portfolio in direct investments. But all of us are still using some of those basic structures. It'll be a combination, not just one or the other.
Thanks, Chris. Ms. Yamamoto?
Hi, I really enjoyed the videos, and I think I'm that kind of a learner too. But one of the things that stuck out was the issues, the risks, it kept repeating that there's more staff time and expertise. How do you plan to deal with that, or how does that work in this whole realm of the investments and the all the advantages of the fees and the expertise that we need to have in order to make the programs work?
Well, you're actually cutting to where we're probably going to hopefully be in May or June or July of next year. Those are the big picture issues. If you are going to take on the responsibility to the staff to make more of these decisions, then you're going to have to think about what does that mean from a structure standpoint? How much more staff do you need? How do you deal with that? there are a ton of questions that would happen, especially, if you layer in, if you want to go overseas, because you have to make quicker decisions. You will also have less diversification overall. So a number of things are going to come together, and what we hope to do through the combination of our research and the consultants is making sure all the questions that you guys have, we're going to have an answer for them. It really is a shifting of the decision-making, where in many cases, when we invest in a basic closed-end fund structure, all the decision-making after the initial investment goes to the general partner. And depending on the structure that you use going forward, you're shifting more of those major decisions to the staff. And if you're going to do that, you just have to have more staffing and more expertise in the staffing in order to make those decisions.
And the staff would have to come to Sacramento generally, or?
Well, if you look at the various models across the globe, some of them are opening offices all over the world.
Okay.
And so these are major decisions. And by the way, no one has done this overnight. These are like 5- and 10-year plans in order to get to the point where you're doing real direct investing. So it would be something as we lay out the options that the board will have to think about. This is how long it will take to get from where we are today to various structures in the future.
I think that probably was the key takeaway from our trip, is that this is long-term planning, long-term thought about where you want to be in the world, and then how you're going to get there and execute on that. That was the most fascinating thing, I think, for us, when they're talking about, okay, we want to look in Asia. How are we going to do that? And that's part of a plan to get there, and they have a plan on how to execute on that, how many years they're going to be there, how they're going to get local staff involved. I mean, it's just, there's a lot going on.
Yeah, which is
And-
exactly what we want this committee
Yeah.
to be thinking about.
Yeah,
at
it's
that-
definitely
at that level.
out there, yeah.
Ms. Hendricks, you took yourself out of the queue. Ms. Yamamoto, are you finished?
I'm finished, thank you.
Sharon, you done?
One thing I would just say, given Karen's comments, is just, when I look at, I really liked the last video, because you kind of just wrapped it all up, and it was this idea of, I think when you look at the slide about optional structures in that bottom section, I think eventually it's like, I think about our staff and go, gosh, being over on the right side of higher discretion, lower fees, we kind of want to, it'd be great for everything to be over there, right? So the question is, like, expertise. When we first looked at infrastructure, it's like we don't have, so I'm excited about this, because I think eventually, however long it takes us, I think we want, we trust our staff, we want staff to gain expertise in certain areas so that we can do more work in-house, that we can lower fees. But I think, the time that it takes for us to do that, and the complexity of our portfolio has grown. So I think we're doing the right thing by starting this study. But I hope we can kind of get over there for our whole portfolio down the road.
Thank you, Sharon. Thanks for the initial presentation to us. Just as a quick summary, the way I see this is beginning with a common language of what we are currently doing. And then secondly, talking about what's possible, what are the risks and opportunities. And then thirdly, what would actually be needed if we wanted to pursue something over a longer period, whether that's additional staff, different expertise, et cetera. And then there would be obviously some discussion around implementation, and then ultimately the oversight of how we would oversee such a significant change and shift. But this was a good first step in a work plan, helping us to get into a common language and an understanding that some of this is already taking place inside CalSTR's four walls as we speak. Thank you. Okay, we are information requests. Mr. King, do we have those information requests?
We have a few, sir.
We do, okay.
Going back to our comments earlier this morning, following the treasurer's comments, excuse me, the committee directed staff to research portfolio exposure to companies that manufacture or sell firearm accessories that allow semi-automatic weapons to simulate fully automatic weapons. Also, we had public comment from Unite Here and employees of the Pullman Hotel. Following those comments, the committee asked for a follow-up report in February regarding CBRE's response to the employees and Unite Here's organizing efforts and their efforts to engage them. And then regarding item number 6, that concerned corporate governance. The committee requested monthly updates on corporate governance engagement activity in kind of a summary or bullet point format.
I don't know if did we say month, did we initially say monthly?
I
I think maybe quarterly reports would be adequate for what we're trying to do, is just get quarterly.
Quarterly?
Yeah, the quarterly news, the bullet points, right? Is that the one we're talking about?
Yes.
Yeah, I think quarterly is, Ann, do you think quarterly is better than monthly? Yeah, quarterly would be
Mark it
fine.
down as quarterly.
Yeah,
You had to add.
yeah. Yeah. Daily?
Daily updates? We're good.
Okay. Anything else,
We
Mr.
get
King?
that with cybersecurity.
That's all I noted, sir.
All right, thank you. Anything else from the committee that we missed? Thanks for always capturing that so well for us, Lamont, appreciate it. Chris, I'm going to turn the review of the next agenda over to you. If you just handle that one, please.
Thanks, Harry. Obviously, we got quite a few of the, and thank you for that, for the investment policies adopted, so we won't need those as second readings. We are bringing back the investment beliefs, so we're hoping to be able to wrap up investment belief number 8. We also have, if you remember at the July meeting, there was a lot of discussion about the ESG policy and the divestment policy. I have to throw a caveat. Those are on the agenda. We may not get to those now that you've put the 2 engagement priorities first. So I'll work with Ann to see where our time is between now and February to get that done. But you added, as Lamont said, an update on the divestment of the firearm accessories, and then an update on the Pullman Hotel discussions. We do have a panel. Ashby Monk, Professor Ashby Monk from Stanford is going to come. And we have right now already 2, one from the former Canadian plan and one Canadian plan to come and talk, not about their model, as we've heard that, but more about the discussion we just had. What's the cost of direct investment? What's it take to do it? The pros and cons about it, and really get into, there's certainly been a lure of success, and some produce very good numbers, but what is the experience of some of these entities? So hopefully that will actually be very conversational. I really will try and come up with some suggested questions for you, but really it's intended for you to fire off at them and get them to open up about maybe some things that didn't work as well. But we'll continue on the staff discussion there. It also will be a full agenda, but I think we'll be able to be very efficient.
Thanks, Chris. So with that, we are going to take a 15-minute break. We'll come back into, what's that?
Okay, nothing. That's a lot.
We're going to take a 15-minute break. And then we'll come back in closed session. For the remainder of the day is in closed session. We have 3 hours allotted for closed session. I think we could probably do that closed session in probably 2 hours. So if we're thoughtful about that, I think anywhere from 2 to 3 hours in closed session. So we'll take a break until 20 minutes till 3. Thank you.